We're getting even more interested. This wave 2, by the way, is a sharp correction. There is no new low made within it. How was wave 4 supposed to develop? It was supposed to have a new low and be very complex. Notice it had an A, and this B went to a new low, and then we had a C rally to complete wave 4. We're going to look at the detail of that area of the chart on the daily chart now. This is a weekly chart of futures. We're now into the last portion of the declining phase, and you go back to your chart book and you say, now it's getting serious. I want to start following this on a daily basis to try to decide when the low is in place. This is a blow-up of the last 2 waves in the sequence. On the weekly chart, we're now looking at them on a daily chart. This is the end of the 3rd wave, and notice, as I said before, wave 4 was a complex pattern, a sideways pattern, indicating it would probably have a movement to a new low within it. It did so, A, B, wave C to the upside. For those of you who are versed somewhat in Elliott analysis, you'll notice that this is a diagonal triangle, which is the only formation which allows an overlap, and Dave will cover that this afternoon. Wave 4 ends, again, it was in the area of the preceding 4th wave, just where it should have ended. Now what are you looking for? You're looking for the 5th wave down, the 5th intermediate wave, the one in parentheses. How many waves should it subdivide into? 5 waves. It's likely to carry to a new low, below wave 3, and is likely to end somewhere near the major bear market's preceding 4th wave. And now it begins to develop in an interesting way. Wave 1, wave 2, which is quite complex, you notice, in a sideways shape. Wave 3 carries you down to this particular low. Wave 3 is longer than wave 1. Then comes wave 4, which is sharp and against the trend, unlike this rather complex sideways structure. And then you're ready for wave 5. If you look very closely at the daily ranges, even within this last minor wave 5, you can see a decline, a recovery, a sharp movement down with a gap in the center, that's the point of recognition, ending a 3rd wave, a little rally for the 4th, and a decline into the intraday low at the end. If you had an hourly chart and wanted to look at the subdivisions of this last decline, you would see 5 waves down into that low. If you went to your quote graphics machine and checked the 5th wave on the 5-minute bar chart, you would see 5 waves down right into that low. Well, for the moment, let's just assume that you're working with a daily chart. And for the moment that you've counted it correctly, and you've counted 5 waves down, you're at a new low below wave 3, you're into the area of that previous 4th wave low, which preceded it years ago. You've counted an ABC from the top, 5 waves in A, 3 waves in B, 5 waves in C. Every one of the declining impulse waves within wave C subdivides into 5 waves. You have now satisfied all of the rules and most of the guidelines required under the wave principle. If you are to enter an order, you'll probably wait for a reversal to indicate that wave 5 is possibly over. You put your purchase in as soon as you decide that that has occurred, and where does your stop go? Right there at that low. And in this particular case, you have caught the end of a multi-year bear market, or at least the first major phase of a multi-year bear market. And look what you did to identify it. You counted to 5. That's all you had to do. Did you know what the fundamentals were? Did you know how many tons of cocoa were sitting in stockpiles? Did you know how many ships were laden with the stuff in the harbors? Did you know whether the crops were doing well that particular year? Did you know whether anyone had developed a substitute for cocoa lately? Did you know what the trend of chocolate consumption around the world was? You didn't know any of that. How about the technical aspects that most people might be interested in? Did you know what the psychology of investors was due to, say, the bullish consensus among advisors? You had no idea how many bulls or bears there were. You weren't following the put-call ratios or the open interest in the futures. What about all of the Elliott wave things you could have looked at? Did we do any channeling? No. Did we do any Fibonacci calculations to estimate where this might have bottomed? We didn't do any of that. There are some guidelines we haven't discussed yet that were not applied. All you did was count to 5. And you were able to identify the end of a bear market that was fooling people every single day it was in progress. Now, let me cover one other aspect of the wave principle that I think is very valuable, and that is what it does for you when you are wrong, when you make a mistake. Let's assume, for instance, that you were watching this daily chart and trying to pinpoint the low of the final 5th wave, and you recognized wave 1 and wave 2, and then this very severe decline got underway, and you said, oh man, that's sharp enough for a wave 3, and here's a bounce. There's no overlap. I'll put my 3 right here and my 4 here. So when the market makes a new low and then reverses, you buy it, saying we've had a 3, 4, 5 into a bottom. Where do you place your stop? 1 tick under that low. Because you see, if a pattern is over, it's over. There's no fooling around. You're either right or you're wrong. You either caught the low or you didn't. If you didn't, you may have only missed it by a small amount. On the other hand, you may be wrong by a mile. Why take the risk? If that low is taken out, get out of the position. How much have you risked? A few percent and maybe the commission. You've got your low here after the bounce. Market comes back down and takes you out, bounces again, and you're going home saying to yourself, well, I'm pretty miserable. I thought I was catching a low here and it took me out. But how miserable are you compared to the guy that tried to catch a low about 3 months ago? And he's still long. So you sleep on it for a couple days and you say, well, wait a minute now. I remember when Bob was giving that presentation, he said that wave 3 very often subdivides into a 5-wave sequence. Maybe I should put my 3 here. My 4th wave peaks here just slightly above the area of this previous 4th. And here we have a 5th wave down. There's a little gap in here too. And another reversal. That's a pretty big reversal day. I'm going to buy it, put my stop there. Well, you have now caught the exact bottom at very minimal risk. The other beauty of this entry, this kind of entry, is that you can now let your position run a long way, understanding that your ultimate risk in the position is almost 0. Now, I've been stopped out plenty of times in my life and in the Elliott Wave Theorist, but almost never with a major loss. We have rarely been caught invested for a long period of time on the wrong side of a market. And it's strictly because the wave principle, if properly applied, if objectively applied, does not allow you to do it. Now, that's not to say that sometimes we make mistakes and we say, well, look, I'm going to let this one go because I'm so sure that we're almost ready to come into a high or a low. I mean, I've made mistakes like that myself. Those are human errors, though. They're not errors that the wave principle dictates or even suggests you should be making. Well, here's the outcome, just to orient you to it. That was the exact low, at least for quite a period of time. And cocoa then soared from 1,300 to 2,800. And just so you realize that this just never stops, I'd like to show what happened some time thereafter. This was the low we caught right there, the 5th of C. Cocoa had a powerful advance from there. And without going through all the Elliott wave ramifications of this, I want you to understand how psychology was working. What kind of psychology do you think was present at that low in December of 1982? The bleakest imaginable. The quotes in the financial press on cocoa, when you could find them, it's not exactly the most popular thing to follow, were negative. They were bearish. They were all giving arguments as to why cocoa would go much lower. That is normal. This is what you should expect. This is what is required for a bottom to be made. Of course, the psychology had changed by this time. Now let's read what some analysts were saying when cocoa was at 2,700 and moving vertically. You see this advance here? That's just soaring straight up. So it's almost as if it's a gimme to make comments about how high it's going. It's holding up like a Picasso, one guy says. The next stop is 3,000. This person is looking for a rally over the next few weeks of 2,800. It's in a blazing bull market, says another one. Prices to rise, not necessarily in a straight line, but certainly much higher. Here's someone else looking for 3,000. Here's someone else looking for 2,800 to 3,000. Now, it's not really too tough when it's been going up, $100 a week and is currently at 2,700 to say it's going to go to 3,000. I mean, that's kind of just normal extrapolation. But you know what? Never made it. Peaked at 2,800 on a spike, right with the most ebullient psychology, and turned down from there. One of the most interesting comments about cocoa during this rise was how mysterious it was that it was going up, because everyone knew there were many, many stockpiles of cocoa being held, and they couldn't understand why the price was going up. The reason is it had already gone too far on the downside, and it was time for psychology to change. And this goes on and on. They're bearish at the bottom, bullish at the top, bearish at the bottom. It goes on forever. If you've missed a move in a market recently, don't worry about it. There's another one coming up, and it'll have the same characteristics, the same wave shape, the same psychology, the same kind of news that's trying to throw you off the track. And once you get used to all that, it starts to be like a replay. And you're starting to watch the same thing over and over. And after a few years, something may happen to you, which has happened to me. I don't look at the name of the chart anymore. I don't care what it is. I've seen this happen before. I look for 5s and 3s, and I look for the rules to be satisfied, the guidelines to be satisfied. I don't even know sometimes when somebody puts a chart in front of my nose whether I'm looking at a 5-minute bar or a weekly bar. You interpret it the same way. And once you get used to that and start ignoring what's irrelevant, it will not only make you a better trader, but it will keep you from getting tripped up as much by listening to all the news. Now, news has some value, but it's exactly the opposite of the way most people think it has value. And that is, let's suppose you've decided that a new bull market has started in the market you're watching. And all of a sudden, a piece of very bad news comes out, and the market, probably because it was at the end of a wave 1 or a 3 or a 5, on the way up, moves sharply lower. Most people are looking at that news and saying, oh my gosh, terrible news, I better get out before I get hurt. What's your answer to that news? Buy. You look at the wave structure and decide where the low should occur, and you buy it. You use that news to your advantage, not your disadvantage. And that's what having a perspective, an overall perspective on the market can do for you. With these rules and guidelines and wave counting exercises that we've done today, you could quit right now and you would know more about the wave principle than 90% of the people who are putting letters and numbers on charts for publication today. As long as you stuck to those rules and guidelines, you would know more than they know and you would do better than they do. And I'm convinced that you would be able to assess markets better than 80 or 90% of the professional market analysts out there today also. However, there's still a lot more of value behind the wave principle. There's a lot more to learn, and that's what the rest of today and tomorrow are going to be dedicated to. So stick around. Thank you.
If you would like to participate in the wave counting quiz, examine this wave structure and label the chart in your workbook. Robert Prechter's discussion of the correct labeling will begin in 30 seconds.
All right. Got a little surprise here. I know you weren't expecting this at this time. I think it's time to take a look at our quiz. Now, apparently, you were asked to turn one in a while ago, and none showed up. At least none with your signatures on them. But I'm sure some of you figured this one out. Let me ask this question first. How many people here were able, in their opinion, to count successfully a 5-wave upward movement? Okay. How many people thought it was something other than a 5-wave movement to the upside? Okay. Well, I think it is extremely difficult to count this as 5 up. I would go as far as to say impossible, but there would probably be one way you could get away with it if absolutely no other count were available. I'm not going to show it to you because I don't want anybody to try it. However, this is clearly an ABC count. It's a very simple corrective pattern, not complex as you might think. In any case, let's try 5s first. Would it be acceptable to go 1, 2, and then have a subdividing third wave up to there? The answer is no. That's right. You've got overlap between wave 4 and 1. Could you have an extended first wave, a 2, 3, 4, and somehow get a 5 out of that? No, because the third is the shortest. Every time you try to make a 5 out of this, you should have had problems. You should have ended up breaking a rule and therefore saying it can't be a 5. The quickest way to deal with this, and it involves something that a lot of people have difficulty finding until they've seen a lot of them. It's a triangle in the middle. So it's a simple ABC count. Now, I must admit I threw you a little curveball by saying this had to come down at least to this level, but I did say at least. And eventually, of course, you probably see something like that. That is a rally in a bear market. The first clue to identifying the fact that you're in a corrective wave is that trying to count 5 waves up, or even the beginning of some 5-wave upward pattern is difficult or impossible. And the harder it is, the more likely a correction is in force. So I think this may not be the only interpretation, but it's the best one. It's the neatest. It's the most economical. One reason it's better to use a simple ABC count when you have a choice between counting something as an ABC or as a double zigzag, ABC, X, ABC, is that this could easily be followed by an X wave itself. X down to here, you see, and then another ABC pattern. And if you'd already counted it as a double zigzag, you wouldn't be expecting that to happen. In this case, it counts as a simple correction quite easily.
The purpose of this quiz was to reveal whether you had learned 2 key rules of the wave principle well enough to know that the formation was not a 5-wave structure, but had to be a corrective structure. For a full understanding of the patterns available so that the ABC wave count would have been precisely identified, be sure to pay close attention to Dave Allman's presentations on impulse and corrective waves.